All right, welcome back to Matt Talks Mortgage, and in this channel we talk about anything and everything that you're going to need to know to prepare for purchasing a home or refinancing. Today, we're diving into a topic that affects a lot of first-time homebuyers. And that topic is, can I get a mortgage in the Dallas-Fort Worth area if I have a lot of student loans? Most of these young working professionals just came out of college. A lot of them took on student loan debt to get their degree. Now they have a great job, but they might have a decent amount to a lot of student loan debt, and they're not sure or afraid that that's going to affect them. So the short answer is yes. And in this video, we're going to break down how lenders look at student loan debt. Then we're going to break down how they calculate monthly payments you might have to pay if it's deferred. And then we're going to look at a few loan programs that's going to give you the best odds of qualifying with those student loans. So here's how the student loans affect your qualification. So lenders don't automatically disqualify you for having student loans. What they are going to focus on, though, is your debt to income ratio. So your debt to income ratio is the total monthly payments that you're going to be paying on any liabilities on the credit report, like student loans, car loans, credit cards, personal loans. And we're going to divide that number by your gross monthly income, and that gives us our total debt to income ratio. Now, typically between new mortgage payment and any debt listed on the credit report, we want to be anywhere from a maximum of 53 to 57%. Depending upon your credit score and a few other factors. Ideally, on certain loan programs, they're going to want your total debt to income ratio, including the mortgage payment, to be anywhere from 50 to 57% maximum. And that's going to depend on a few other factors. And one of those most important factors is going to be your credit score and payment history. In many cases, your credit score and your payment history matter a little bit more than what you owe on those student loans and how much those student loan payments are per month. So lenders are going to want to see consistent on-time payments. And for loans like conventional loans, they're usually going to want to see a credit score of 620 plus. Now, FHA loans can go as low as 580. Now, some lenders will let you go below 580, but usually require a larger down payment. What we want to do for purposes today is we'll just stick with 580 because that allows us to put the minimum down payment of 3.5%. But all that to say, strong credit can help offset not only the amount of student loan debt you have, but the monthly payment associated with it. So now what we'll do is we'll look at the best loan programs for some buyers who may have student loan debt and concerned about what those payments can do. FHA loans are great for either lower credit or high debt to income ratio loans, but also for those who may have a lot of student loan debt. And here's why. Now, let's say you have $100,000 in student loan debt. Now, on an FHA loan, they will take that $100,000, they'll multiply it by 0.5%, and that's what's going to be your allotted monthly student loan debt payment. So even though you're deferred, the government knows that eventually you're going to have to make payments on that. So we need to calculate or put in a payment to properly calculate your debt to income ratio. So that's why FHA loans are great for that, because it allows for a lower total monthly payment on your student loan compared to some other programs we're about to look at. The next most common loan that we can look at is a conventional loan. Now, on conventional loans, you have Fannie Mae and Freddie Mac, and these are government agencies that put together the guidelines that we as lenders have to follow. So on a Fannie Mae loan, they require us to use 1% of the total student loan amount as a monthly payment. So basically double your payment of what it would be with the FHA. Whereas Freddie Mac, on the other hand, they allow us to use 0.5%, just like the FHA. So for example, someone who might have really great credit and maybe they're putting a little bit larger of a down payment, but have a lot of student loans, they may want to look at a conventional loan with the Freddie Mac underwriting guidelines, because they allow us to use half of what Fannie Mae would allow us to use. And in many cases, that's the difference between qualifying and not qualifying. Next, we have VA loans, which is for active duty and retired military veterans. Now, with VA loans, they're very forgiving with student loans, and just like the FHA, they allow us to use 0.5% of whatever the total student loan balance is in order for us to qualify. So if you could see a theme with government loans like FHA and VA, they are going to be the best, especially if we have, decent credit and a low down payment, to make sure we have the least amount of monthly payment tied to your student loans. So now that we have gone over what each loan program specifically requires for us to use as a monthly payment for your student loans. One helpful tip or trick, if you can make it happen, is if you're currently in deferment and there's a $0 monthly payment listed on your credit report for the student loans, in many cases, we can go to the student loan company and ask them to send us a payment plan. And if they can give us a payment plan that is less than what the FHA, VA, or conventional loan calculates, remember either 1% or 0.5%, we could actually use that, which is going to drop your monthly payment even more, which of course is going to drop our debt to income ratio even more and increase our odds to qualify. So as you can tell, there's several different options as well as a few strategies we can use to help drop the total monthly payment that's tied to deferred student loans, as well as drop our total debt to income ratio to make sure that we qualify. So for instance, here's what Dallas-Fort Worth markets look like for first-time home buyers. So 2025, the median home price was just about $400,000. Tarrant County was closer to $345,000, so a little bit less. Collin County came in higher at $465,000, and mortgage rates in 2005 were sitting somewhere around 6.4%. So all that to say, the key is going to be picking the right price point and the loan program that's going to match the amount of student debt you have, as well as the down payment and credit score available that we have to work with. So next, we're going to talk about just a few tips we can use to strengthen your application, whether you have a lot of student loans or little student loans. So there's a few smart strategies to give your application a boost. And the first one is going to be pull your credit early to fix any errors. What I mean by errors is sometimes there's duplicate accounts that lenders don't catch unless you show them. So now you're getting hit with the same payment twice. Sometimes you're an authorized user on a family member's credit card and you're getting hit with that payment. You didn't know that you were added maybe 6 to 10 years ago or when you were a teenager to help boost your credit. Now, all of these things can allow us to fix it ahead of time and, of course, decrease your debt to income ratio. What we could also do is total up the total amount of student loan debt and see which option is going to give you the lowest debt to income ratio. What I mean by that is with the combination of your credit as well as your down payment and how much student loan debt you have, that'll let us know if we should do an FHA loan and go with a lower calculation for your student loan debt at 0.5%, or maybe a conventional loan if it's not affecting your debt to income ratio as much. Or lastly, if none of those options work, let's reach out to the student loan company to give us an income-driven repayment plan. And oftentimes that is going to show a lower monthly payment than even what we would calculate at 0.5% or 1%. So as you can see, there's several things we could do up front to make sure that we're qualified. So I hope you found this video helpful. Give it a subscribe to Matt Talks Mortgage, and actually check out my website below. It's going to give a full blog post on what we discussed today and more personalized mortgage guidance.